First of all, it is very important to know that why students struggle in this topic. The reason is that there are very less marks available for the calculation of ratios, because calculation of ratio is already in F3 paper. So in FR exam, the focus is on the commentary, that you have to analyze on the basis of the available ratios and other information that what is the current financial performance, what is the current financial position, what other insight you are getting from the ratios. So most of the time you have to compare your current ratio with your previous year, and you have to compare with the competitor, you have to compare with the industry average. So there might be variety of stuff required from this type of question. Now, what you need to understand in order to perform well in this type of question. So first of all, a very important thing that you need to know is definition of each ratio. The definition of ratio must be very clear. What is the meaning of the ratio? For example, say suppose if you can talk about that interest coverage ratio. So you should understand that what is the exact meaning of interest coverage ratio, so that you can explain with the perspective of definition in your mind, right? Why we calculate this ratio. Second thing is that the formula, because although there are few marks available for ratios calculation, but still each mark is very important in exam. So if say suppose 5 to 6 marks are for calculation, so we need to take these complete 5 to 6 marks. Okay, so formula, and especially the alternate formulas. If there is any other formula for our ratio, so you should know each and every alternate formulas. And the third thing is, if you have calculated a ratio and you are comparing it with industry average or the competitor or your previous year performance, then you have to evaluate reasons why there is a change. That is a thing where students are very poor. Why there is a change. And when you talk about the change, sometimes you have to talk about the data given in the question. And if you're not able to locate or not enough information has been given in the question, then some journal discussion. Like for example, if you're talking about the profitability of the business, so we know that why profitability go down. There is an obvious reason for the fall in the profitability, and that is the expense. If suppose there is a fall in GP margin, so the obvious thing comes in my mind is cost of goods sold. But if you want to write about cost of goods sold and you have information about cost of goods sold, so you have to see in the question whether your statement is justified or not. So when you are trying to write about any ratio, any reason which is in your mind, then you have to cross-check that reason with the available information given in the question. And there will be marks for identification of reason, that why a ratio has been increased and why a ratio has been decreased. And at the end, if examiner asks for any recommendation, so you have to recommend or conclude about that what is the overall financial performance and financial position of the business, right? So I'm not going to discuss the calculation side. We'll calculate whatever ratio we have to see in the given question. So our focus is to talk about on the interpretation side, right? So for example, The categories of ratios that we need to calculate is, one is profitability. And in this category, we have to calculate few ratios. And the second category we have, it's liquidity and working capital ratios. The third one is we have solvency and gearing ratios, risk related ratios. And fourth one is the investors ratios. These are the total ratios available. In this investor category, usually the focus is on 1, 2, and 3, because in investors category, IAS 33 is already there. So examiner can ask question on IAS 33 separately. So our focus on profitability, liquidity, working capital, and solvency ratios. So let's talk about, first of all, the reasons behind change of few ratios, which are very common, which are very frequently being asked. For example, let's talk about gross profit margin. As you know that the formula is gross profit over sales multiplied by 100. This is the formula. So the obvious thing is that if there is suppose decrease in gross profit margin, let's assume that there is a decrease in GP margin. So now the reason behind the GP margin, you should know in advance, right? The question will tell you about something extra, but you should know in advance why GP margin decreases. So the obvious thing you can see in the question is that what is the formula? Formula will give you the answer that what might be the possible reason. So one of the reason is decrease in GP margin is your increase in cost of goods sold. Remember, this is the possible reason. We have to locate reason in the question, right? But if no information is there, limited information is there, then you can write that this is the possible reason. Increase in cost of goods sold, and GP margin might be decreased due to decrease in selling price. If you are decreasing your selling price, the impact might be your increasing revenue. So if revenue has been increased and still you're not able to get the higher gross profit margin, then obviously that there will be a negative effect on gross profit margin. Now, in an exam question, you don't have enough time to talk about detail of each and every item. So the obvious reasons you have to highlight, but I can write many reasons behind cost of goods sold. I can talk about selling price. I can talk about elasticity of price, demand. I can talk about the competitive behavior of the market, but obviously we have limited time. So we will be within the range of the marks available. Okay, 1 or 2 reasons are enough. Okay. So increase in cost of goods sold or decrease in cost of goods sold. One other thing is production cost. If you are producing something, production cost might be the reason. If you are purchasing something, then the cost of purchase. Your supplier might have increased the price. There might be some inflation effect. Anything can be possible. There are so many reasons, but be in your limit in the exam. Okay. These are possible reasons. Okay. Now let's talk about another ratio, and that is the operating profitability margin. Operating profit margin. Do one thing, write down the main reasons of every ratio. Okay. On a separate sheet of paper, write down 2, 3, 4 possible reasons, right? And then in the exam question, check the scenario. If your reasons and the information is similar, then you can write. Okay. And then you can connect that this is the reason, this might be the reason. Examiner want reasons for the marks. If you're not giving the examiner reason, the marks will be limited. As per the formula, this is PBIT over sales revenue multiplied by 100. Now, obvious thing is that if your profit margin has been decreased, so obviously the operating profit is an outcome of gross profit. So gross profit might be the culprit. Then the biggest culprit is your operating cost. Am I right? The biggest culprit is your operating cost. Now, in operating cost, you might have administration cost change. There might be some increase in administration cost. There might be some increase in distribution cost. And in this operating cost, you know that we charge depreciation, amortization, we charge impairment losses. So we have to check whether we have recognized these in cost of goods sold or somewhere else. So one of the obvious reason for PBIT is the cost. Okay, there might be some one-off cost like loss on disposal of asset, as a result of which there is a change. And remember that if any ratio has been decreased, it is not necessary to have a poor performance. For example, let me give you one example. For example, increasing marketing cost. Suppose the company has heavily invested in marketing cost, and as a result, the marketing cost has been increased. So operating profit margin has been decreased. And a student is writing that the company's performance is not good. You have to see the scenario why there is a change in the cost. What would be the future consequences? Because you are invested right now, so it will affect your future sales. So you can write that for the time being, my profitability is not good, but if I have a successful marketing campaign, then it would possibly increase the next year's sales figure. So profitability might be increased. There might be, the reason is research and development cost. Now, if as a result of research expense, there is a negativity in profitability, do you think this is an adverse thing to discuss, or is it a positive one? If a company is incurring cost on research expense, then the benefit might be some future benefit that the product will be a part of the development phase, and after development phase, it will generate revenue. So be careful about the result of the ratio and think about why there is a change. Okay. The third thing is net profit margin. Yes, I'm not saying that the exact thing is, but as an analyst or as a user of financial statement, you have to see both the positive side of the story as well as the negative side of the story, right? The net profit margin, the third one, the net profit margin. It's sometimes PBT, it's sometimes PAT, before tax margin or after tax margin. Here, if there is any fall in the ratio or increase in the ratio, if there is a decrease in profit margin, so obviously the main culprit is your finance cost or your finance income. Because after operating profit, the leftover is your finance cost or finance income. Now, this finance cost, if you have to discuss why there is a change in finance cost, you have to connect it with your gearing ratio. You have to see in the question that what is our debt position? What change we have in the current year from the last year? We have increased debt, it might be. We have decreased debt. We have substitute debt. There might be some short-term debts. There might be some long-term debts, because the rate of debt vary from short-term to long-term. Okay. So if the company's gearing has been increased, it will increase the finance cost of the business, and as a result, its profitability will be affected. So these three are primarily profitability ratios, and then we connect two more, and one is very important, that is return on capital employed. This is a very difficult ratio to explain because it is sometimes a misleading ratio. So you have to be careful in analyzing such kind of ratios, very careful in numerator and very careful in denominator. Now here, what we want to see is how much return generated by the company. And we are comparing our return with what have been invested by the investors, that is capital employed. So obviously the return, if return are high, then the return on capital employed might be good. Yes, there is a loss margin as well. If there is a profit margin, obviously there is a loss margin as well. And if the last year loss margin was 10%, now we have 6%. So this is a sign of positivity. Okay. What we will do when question state that this is the initial years of the business, like first year or second year, because in the start of the business, you know, there are always losses, very difficult to get profitability earlier. So examiner can give you any kind of data, any kind of company, any kind of situation you have to deal with. And remember, we are talking right now for profit organization, right? We're not talking about the not-for-profit organization. It's a very, very detailed topic. Each and every ratio takes time to discuss, right? Now, sometimes you have a positive return on capital employed, right? There is an increase of 10%, suppose. Now, having seen this 10% rise, student will usually say the company is very good, the company is generating good profit for its capital employed, for lender, for shareholder. But what if your profits are decreasing? If your profit margin is decreasing and your return on capital employed has been increased, so there is a conflicting arguments. Now you have to see why there is an increase, because the reason might be change of return on capital employed, obvious from the formula. One is the impact on PBIT. This is a genuine reason, impact on PBIT. Another might be impact on capital employed. So if capital employed has been changed and due to which there is a change in my ratio. Okay. Yes, revaluation is one of the reason. Very good point. Revaluation is also a reason, because revaluation is an accounting adjustment, right? If you are comparing you're comparing your ratios with last year or with your competitor or industry average, and last year there was no revaluation, but current year there is a revaluation. So how that affect? It will increase the equity side. Obviously, it will increase the equity side, so as there is an impact on capital employed. And if capital employed is increased, that means that the return on capital employed will be decreased. Similarly, the depreciation policy, that how you are depreciating your asset, the change of the asset, how frequently you are changing your asset. So this ratio can be manipulated by changing the capital employed in such a way that company looks good. So we have to be careful about this ratio. Next one is return on capital employed. So next would be return on equity. By formula, this is profit after tax divided by shareholders equity. You should know what is the definition of equity. It includes all kind of reserves along with share capital. So this is basically what you're trying to understand, is that how much profit has been generated for shareholder. So return on capital employed is for lender and shareholders, and return on equity is for just shareholder. You know that shareholder interested in profits. If profits are increasing, there are chances of a good dividend that is to be paid to the shareholder. So, but if there is a decline in, suppose there is a decline in return on capital employed, so the obvious reason which you feel is fall in profitability. So you have to check your net profit margin. You have to see what is my net profit margin. If your net profit margin has decreasing, then obviously this is the reason. But the other side of the story, that what are the changes in equity? For example, there is a revaluation surplus. There is a decrease in revaluation surplus, or there is an increase in revaluation surplus. Okay, there might be some like gain on investment, which has been incorporated in OCI. There might be some OCI effect. Okay, so such kind of items you have to identify why there is a change in equity, and you have to identify the reason behind change in return on capital employed. So this is the first category. I have given you few reasons. More we will discuss in the question, and we'll connect with this as well. Dividend, obviously, dividend has an impact on equity, but dividend is in the favor of the shareholder. If dividend decreases your equity, for example, the retained earning has been decreased, but this is not a negative sign. This is a bit positive sign. And increasing return on equity means favorable dividend now or in future. Next category, very important. This is called the liquidity and working capital ratios. You know that liquidity is very important for any organization. Liquidity is like, you cannot survive without good liquidity. If you have a poor liquidity, that reflects in the balance sheet when you have overdraft, right? So if you are evaluating your balance sheet position and you see you have overdraft, what comes in your mind? That the company has poor liquidity, and that the reason behind that poor liquidity is working capital position. And working capital position is to deal with your balance sheet receivables, payables, and inventory. So let's first discuss the working capital ratios. The first one is debtors or receivables turnover period. I'm discussing the days formula, right? So we have to see average account receivable or closing account receivables. We have credit sales and 365, the obvious days. Now, for example, you have to find out the reason, okay? And previously we have like 50 days of credit period, and now that has been enhanced. It's 60 days. Now, every student knows that it's not good for the organization. Am I right? It's not good for the organization, because if debtor days are increasing, it means you have to finance these from the bank overdraft. That would put a pressure on your liquidity. But sometimes the company intentionally allow debtors to take few more days. Okay. And if you have to suggest any policy, then you can suggest that what you can do in order to attract customer to pay you early. Okay. And it might be a poor administration. What do you think? A poor working capital policy, a poor administration, your inefficient working capital management, credit control department might be the reason. See, we have reason for every ratios, okay? But we have to connect with the scenario, right? Remember, every time, these are the journal reasons. Obviously, we have to connect with the scenario. We have to look out, right? And if you think that these are the factors which are similar, so you can write it easily. So in advance, you have something in your mind, okay? So the obvious reason I'm writing. The second reason, and also remember that industry average is very important. If you are around industry average, then it's good. The second is inventory turnover. Now, inventory turnover, I already told you that you should know the definition, what it means. Many students do not know the exact definition. Inventory turnover is how fast you can convert your inventory into sales. So obviously inventory has a holding cost. So the more you carry inventory, the more cost you have to bear. So the ultimate thing is that you have to make it fast, like turnover must be very fast. So you can convert inventory into sales, sales into cash flows so that you have a good liquidity position. But if your inventory turnover in days taking time, so you have to think about what is the problem, right? Do we have some stock which is, due to poor advertisement, you are not able to sell, due to some change in trends, what we are not offering any kind of discount, what to do? Do you need to offer bulk purchase discount? Do you need to them some incentives to buy? What we need to do in order to increase the speed of the conversion? Okay, so for example, if my answer is in 30 days I am able to sell my inventory, so what I can do in order to convert it into 20 days? The early, the better it is. Okay. Third one is, sometimes it happens that supplier is offering you bulk purchase discount, and as a result, you are piling up your inventory. Okay. Sometimes you are anticipating demand, and as a result, you are piling up your inventory. There might be many reasons. Creditors turnover. Creditor is a free source of finance. Am I right? Creditor is a free source of finance. So student thinks that they can write that as much as possible. You can increase your days as much as possible. Now, this is not a finance strategy. Your supplier is also very important. So the relationship, you have to be aware about the relationship. You have to follow the industry norm. You have to pay your supplier on time. You have to think about that if you pay early, what kind of discount has been offered by a supplier? What about your credibility in the market? What about your goodwill position? What about your discounts? So if there is any change in creditors turnover period, if you are paying early, then why? Then ask yourself why? Why you are paying early? If you're paying late, why? Do you have problem in other parts like inventory and receivables? That's the reason why you're paying late. So you have to think about why. Why is very important. Why, and why. Okay. Now these three ratios, debtors turnover, inventory turnover, and creditors turnover, right? These creates your liquidity profile. Okay. And then if you calculate the fourth one, that is the liquidity ratio, obviously, if you have a poor working capital management, your liquidity ratio would be falling, or a poor liquidity ratio. So this is current ratio. It says that for each current liability, how many current assets available. And the benchmark, the ideal is usually 2:1. But again, we have to see the industry. So if there is a fall in liquidity, again, think why. So this might be increase in liability, increase in overdraft, and that is the reason why your liability is increasing, but simultaneously your assets are not increasing. And why your overdraft has been increased? This is the reason why, due to debtors issue. So one ratio is explaining the other. You can connect ratios as well. Okay. And as you know that why we calculate the quick ratio, the reason behind quick ratio, if there is a change in current and quick ratio, then you have to explain the impact of stock on your liquidity position. That what kind of stock you are selling, the value of your stock, what kind of stock you are selling. Is your stock slow moving? So then you are utilizing that what other assets you have that are able to pay off your liability when the liability is becomes due. The next category, solvency. And in solvency, one of the very famous ratio is debt to equity ratio. Here we are looking towards the risk profile of the company. What risk we are looking? It tells us about the financial risk of the business. And the financial risk has been created due to excessive gearing, due to excessive debt financing. Now you have to see in your non-current liability that what are the changes in your debt. If you have an increase in your debt financing, if you have a decrease in debt financing, what is the impact on your equity side? Will you have a share issue in the current year, right issue and something like that? So you have to see the position. So if you have a debt to equity ratio, suppose you have a debt to equity ratio like 120% has been increased, then you have to ask why there is an increase in debt ratio, why you have raised financing, why you have raised debt finance this year, what is the positivity behind debt financing and what is the negativity behind debt financing, what is positive, what is negative behind debt financing. You have to answer this. Remember that I can talk about something in favor, that debt is a cheaper source of finance. Okay, debt is a cheaper source of finance, but simultaneously there is a negativity that interest is a commitment. Interest is your commitment, so you have to pay at any cost, and that creates that increase risk to shareholder. What risk shareholder has to face? That if your interest is high, there will be less availability for the dividend payment for shareholders. The next version of this is debt divided by debt plus equity. That is the total equity, right? Total financing. This is another side of the gearing ratio. And here you compare your debt with the total. For example, if you have a debt of 500 and equity of, say, suppose you have like 1000 of equity. So what is the answer? The interpretation is different, debt to equity ratio as compared to debt divided by debt to equity ratio. So this says that in total financing, how much debt you have already raised. The reason will be similar, that although debt is a cheaper source of finance, but it will put some restriction on you. It will create a burden of payment, which is a fixed payment you have to pay each and every year. So you have to see the overall position. If your profitability is good, can you advise debt financing? If profitability is good, yes, debt is better. Now you can afford debt financing. But if you have a poor year of profitability, the profitability has been falling down, then ultimately you will not advise debt financing. Rather, you can say that reduce debt by issuing right shares or other securities. Okay. Another thing is interest coverage ratio. The formula is PBIT divided by your interest commitments. This is again a very important ratio. We calculate from the profit and loss account. So it says that your potential to pay interest, your capacity to pay interest, your potential to pay interest. Now, this is again connected with the risk, that if your profitability is decreasing and you have increased your interest, so obviously there is a fall in the interest cover ratio. For example, it was previously 8 times, now it's 5 times, then you have to ask why there is a decline in the ratio. And obviously, as per the formula, one thing is fall in profitability, Another obvious thing is increase in interest due to increase in debt. And if debt, long-term debt has not been increased, then you have to talk about there might be short-term debts. You have to see in your position that what are my short-term debt position. Okay. Now, any question up till now? I have covered few important ratios and I've tried to explain few reasons behind that. As I told you, we have to connect with the scenario. So when we see the scenario, that we will be in a position to discuss about that. Sometimes a single company financial statement will be given, so you have to comment on that. Sometimes you can see you might be given some consolidated financial accounts figure. So variety of question you have to practice, and remember you have to write. The important thing, the most important thing that you have to do in order to have a good understanding of ratio is try to write. Try to write as much as possible, because without writing, right, without writing, you're not able to get good marks. Initially, it happened that when you try to write, it will take time. You might be a poor answer, but don't worry about that. Try writing, try to practice. Okay, there might be a time that you can write a good answer. So let's discuss one past paper question and let's evaluate what we have to do in this question. What is the requirement? What type of question is that? So by practicing variety of question, different types of question, different industry, different data, we'll be able to get a good grip and obviously have some good marks from the exam. So let's discuss this question, very huge one. So this is a past paper question. Okay, let's discuss this question. First of all, the requirement, what we have to do. So requirement number 1 says that calculate the missing ratios for K. All lease liabilities are treated as debt financing. It means that the current portion of lease liability as well as non-current portion of lease liability, okay, under IFRS 16. And profit before interest and tax should be used for the calculation of return on capital employed. The marks are just 4 marks, okay, and missing ratios have been given. We have to calculate return on capital employed, we have to calculate profit margin, we have to calculate payables, and we have to calculate gearing ratios. 4 easy marks, 4 ratio, 4 easy marks. In the next, using the above information, assess the relative performance and position of candid and covert for the year ended September in order to assess the directors to make an acquisition decision. Now it's very important. Why you are analyzing? What is the purpose of analyzing these ratios? The reason is you want to acquire one company. So on what ground one company is better than other? So you have to look towards few ratios. You have to see the profitability is the criteria, right? The liquidity is the criteria. You have to see the risk position and other factors that you think are important in order to take a decision. Obviously, without any thorough investigation, will not take the acquisition decision. Okay. In the last part, it says that describe what further information may be useful in order to decide the acquisition decision. Because obviously, from a single year, from just financial statement or just single financial statement, 1 year financial statement, you can't conclude. You need some extra information. You need some non-financial information. So you have to write something in for this 4-mark question. So let's begin with the calculation side. Let's first discuss the whole scenario, the whole question. Expend is a public entity, useful information. I'm highlighting the useful information that will improve my writing, that will give me points to write, okay, which has grown in recent years. Expend has grown in recent years. How? By acquiring established businesses. Now, this is a very important line, that the company concerned, which is planning to acquire another company, is already has the credibility or already has the trend of buying another established business. So if we are looking for another company, so we are obviously looking for some established business. The following financial statement of 2 potential target entities are shown below. They operate in the same sector. This is very important. Same sector means it is a like with like comparison. Okay, it's a like with like comparison, but same industry might have different size of business. Okay, different size of business might distort the ratios, might affect the ratios. They have different product range, they have different customers, they have different locations, they have different, mindset. So that will affect the ratios. But Expand believes their shareholders would be receptive to take over. So how you can respond to your shareholders requirement? As indicate price for 100% acquisition. Now it's very important. We want to buy 100% shares in 12 million each. So we want to pay 12 million for 100% acquisition. Obviously, we have to raise finance for 12 million acquisition, right? Now we have been provided with balance sheet of 2 companies, but for just 1 year. This is a lacking, right? This is a lacking in analysis. At least you should have last year information. I'm highlighting my concern. Last year information, some industry information, some trending, some trend data, some trend analysis. Okay, so that will help me in deciding what to do. Revenue we have, you can see the size of revenue. Here you can see that Covert has 40,000 revenue and Candid has 25,000 revenue. Ask yourself a question. Why? If they are working in the same sector, why there is a difference between revenue? And accordingly, the gross profit margin, the gross profit is different. The gross profit margin might be different. Distribution expense, we have finance cost. Look, their finance cost comparison. I'm just doing without ratios right now. Their finance cost comparison. Covert has heavy finance cost as compared to Candid. It means that if you can look towards the debt ratio, you can see here the debt is same. Like the loan, one company has 5% loan, the other company has loan, the rate is different. There might be a reason of change in rate. Okay, and one company has lease liabilities 4,200, also as current portion of lease liability, and as a result we can write, obviously you will get marks, that high gearing is the reason due to which we have to incur high finance cost. Selling the inventory at lower price in order to increase their sales, this might be reason, and not charging much profit in order to attract new customer. Yes, your margin might be low. You have decreased your selling price. That's why they are, or maybe the nature of the product might be such. I already told you we can write very much, but we have to be in your limit. We have to write few reasons rather than for one ratio you are writing 2 paragraphs, and for other you are not writing anything. So reason 1 or 2 for each category or ratios. Okay. Now you can see profits, obviously profits, but here you can see a different story. The gross profit 7,200, and as far as the profit for the year is there, we have a different story. The Candid has a high profit as compared to, this is the cause of concern, why Candid has high profit although Candid has low gross profit margin. Okay, so the obvious reason comes in my mind is operating expenses and finance cost, the obvious reasons. Now balance sheet information, as far as you can see, you can get here property. We have property. Here we have no property. Here we have owned plant only. There is no leased assets. Here we have owned plant as well as some leased assets. So it's an important point that should be in your answer. Okay. Earlier I told you, you have to identify factors from the question. The more you identify, the more you connect with your ratios, there are better chance of getting good marks. Inventory position, almost the half. Receivable, almost the half. Bank balance, you can see here, huge as compared to this. Huge, good bank balance. Although you can see the revenue is, Covert has 40,000 revenue, but in terms of bank balance, it shows that something is different. Why? Ask yourself why. Why there is a change. If you don't have enough information, just write hypothetically you have what you have learned from the discussion. Equity shares, almost half. Revaluation surplus. Now this point will affect return on capital employed, return on equity, asset turnover. You should know what information affect what kind of ratios. Okay. Retained earning, obviously profitability has an impact on retained earning. We can talk on this as well. Lease liability, non-current liability. So trade payable, almost half. Lease liability, taxation, and total equities and liabilities. So I've already highlighted much information before going to start comparing the ratios or calculation of ratios. It means whatever I have highlighted, these are marks. Now, if you are able to write it correctly, you will be get good marks from this question. Now see, we have been given a note. Why we have been given a note? There is no government grant in the liability side. Why? Because under IS 20, we studied that if you received a grant related to asset, so there are two treatments. One is deduction approach and other is deferred income approach. If there is a deferred income approach, that will be reflected in your non-current liability and current liability. And if there is a deduction approach, it will affect your asset side. That's why note number 1 has been given, that we have own plant of 8,000. We have deducted IS 20 government grant approach. So we have asset 6,000. Accumulated depreciation has been there, and that has been reduced due to the impact of grant. Okay. Covert has no grant. What would be the impact? What would be the impact of grant? Remember that grant are conditional. Okay. Grant are based on conditions. And if you are not able to follow the conditions, then you might have to repay your grant. So grant comes with some kind of responsibilities, and you have to meet those responsibilities. You can get favor from the government, etc., etc. Okay. And you can see right to use the leased asset information. Its initial value. It means we have leased in the initial phase. The following ratios have been calculated: Candid versus Covert. Return on capital employed is missing. Net asset turnover, you have to compare this. Net asset turnover, gross profit margin, Candid has an advantage here. Profit margin, we have to calculate. Current ratio, Candid has a good current ratio. Closing holding period, Candid has an advantage. Receivable collection period, again Candid has an advantage. Payables 24 days, and gearing is 65.8. So from the above data, what I have highlighted, and from the given ratios, I can conclude something immediately in my mind, that Candid looks very good in terms of liquidity, in terms of profitability. But what about the risk position? I have to calculate. But in terms of net profitability, in terms of the other things, at once I can say that Candid looks good. Okay. So let's calculate the given ratios, missing ratios. Return on capital employed. First one, return on capital employed. Better to write the formula. Profit before interest and tax divided by capital employed. So we are using the ratio of covert, right? So covert's return on capital employed, and it has been given in the question that for return on capital employed, take profit before interest and tax. So what is profit before interest and tax? So my profit before interest and tax is basically before interest. So it's 7,200 minus 2,300, right? So it's 7,200 minus 2,300. So this is the profit figure given in the question. You can easily find out. So now we have to identify the return on capital employed. So for return on capital employed, I can see I have information from shareholders equity. I can take shareholders equity. The shareholders equity is 5,600. 4,200 is lease liability. 5,000 is loan, and 1,000 is lease liability, right? So the equity value, we can take the equity value, 5,600 is the equity. The long-term debts, we have 5,000 plus 4,200 plus 100 plus 1,000 multiplied by 100. Can you find out the answer of return on capital employed? So it's 31%. The return on capital employed is 31%. So now see, Candid has return on capital employed of 62.5%, and here we have 31%. Okay. One of the thing is that the revaluation surplus, one of the reason is revaluation surplus is always there. So as a result, the capital employed figure, when you compare the capital employed figure of both companies, you will find difference, and you have to identify why there is a difference. Okay. So you can see here, the first company, the equity is 2,600, the loan note is 5,000, 7,600 is capital employed. And as compared to this, the capital employed is high. That's why the return is not good. The second ratio is profit margin before interest and tax. So it's profit margin before interest and tax. What it means? It means operating profit margin. So the operating profit we have 7,200 minus 2300, and we need sales, we need revenue. Revenue is 40,000. So multiply by 100 will give you 12.3%. Now 12.3%, let's write here 12.3%. So you can see operating profit margin, Covert is having 12.3% and Candid is having 19%. So obviously Candid has an advantage in terms of gross profit margin and in terms of net profit margin. Okay. And the reason, operating expenses, right? Because we are taking profit before interest and tax. I already told you that one of the reason is the expenses, the operating expenses. Not much have been given. No information has been given. So we have to write hypothetically, okay? So hypothetical information or the assumed knowledge is very important. Payables payment period. Payables payment period. The formula is the average payable. Okay. So take average payable, not given, closing payable, 2100 divided by cost of goods sold. The cost of goods sold figure is 32,800 and this is 365. So my payables payment period is 23 days. Is it good or not good? Payables payment periods 23 days. 23 days. Now you can see there is little difference in these. Almost you can say that identical. You can explain liquidity ratio from this perspective, that what is the current ratio, what is the quick ratio, why there is a change in terms of credit policy. Both looks good, both look same because they are in the same sector. So suppliers policy has been same. Okay. But if there is a difference in current ratio, you can see current ratio 2.1 is to 2.4. Marginally, Candid has an advantage of a good current ratio as compared to this. Okay. So in terms of current ratio and in terms of inventory holding period, you can check the inventory holding period is 38 days versus 31 days. There is some advantage in working capital. Collection period, very good collection period. So it's making a positive impact in current ratio. Now you see the bank balance position as well, side by side. You can see here we have 200 bank balance and they have 1100 bank balance. So it means liquidity position looks very good in terms of short-term performance, and there is no current overdraft in both the companies. So both the companies have liquidity, but the liquidity position of obviously first company is good as compared to other. Now the next and last ratio is gearing ratio. The formula has been given, debt divided by debt plus equity. So gearing, debt divided by debt plus equity. So the long-term debts, they said that include lease liability as debt. So long-term debt is 4,200 is loan, is leased, 5,000 and 1,000. So it's 9,200 and 1,000. It's 10,200. It's 10,200. And my equity position is 5,600. So if I get the answer here, this is 64.6%. Did I take the correct values? Equity 15,800. So let me check. Equity again. So Covert equity is 2,900, 5,600, and that I have Okay, so can you find out the answer? 10,200 divided by 15,800, it will give us a figure of approximately 65%. Along with calculation, I have discussed many things. Now, in terms of gearing ratio, you can see marginal difference. You can say almost the same gearing ratio. But if the gearing ratio both are same and 65% in terms of debt divided by debt plus equity. So it means both are highly geared. Both are in the same sector. They are highly geared companies. One is having loan, other is having the debt only. Okay. It means that one company's gearing is due to leased. Okay. And you can see whenever you can talk about the debt financing also looks on the repayment of debt. We have no information here. Do we have information about the repayment? Yes, we have information. So 5% loan notes, they have to pay in December 20x6 after 1 year, and they have to pay in December 20x6. So it means both has to pay their loan. You can round it off, no problem. There is no difference. You can take the whole figure. Examiner will give you full marks for this mistake of rounding off and like that. Focus, your focus should be on reasoning, discussion, analysis, finding out the data, identify the reasons, information. You can see here in terms of gearing, if it is identical but very huge gearing, then why there is a difference in finance cost? Cause of concern. Finance cost is 900 versus 250. So the reason in finance cost might be, you can see why finance cost is different. You can see here, there is a rate given. 5% loan note versus 10% loan note. It means one company is getting favorable rate and other company is not having favorable rates. Okay. And the difference they have is that the other company has good retained earning as compared to one. That's why there is a similar gearing ratio, although one company has high debt, but the ratio is similar. Now, on the basis of this, we have to identify performance and position on the basis of this. So you can see now we have one category that is profitability. We have another category that is liquidity and working capital, and we have third category solvency. So let's have uh, discuss the in terms of the headings. So you can put here one heading that is profitability. You can also put introduction as well, profitability. You can put here liquidity and working capital headings. You can also put performance and position headings as well. And here you can put solvency heading. Better is to write as per the requirement. If requirement says that discuss the performance and position, then instead of this, you can use the performance and position and identify the relevant ratio in each category. Okay. But in terms of profitability, let me compare return on capital employed. It's almost double, and you have to identify the reason. So what reason comes in mind? The obvious reason, because information, we don't have information about that. So we have to hypothetically think about that. What would be the reason in return on capital employed? Now we can see here 62.5%, right? 62.5%. And the explanation is here in terms of 62.5% versus 31% something. It's 31%. And look the reasons. Look the reasons that you have to quote. Look the obvious reason. Check out the profitability of this company. Check out the profitability. Their gross profit margin is 24%. Their operating profit margin is 19 as compared to 12, but the return on capital employed has almost double. So one of the reason is increasing profitability. Increasing profitability or profitability ratios have been increased. This is the obvious reason we have identified. Okay. Now see, profit margin is one of the reason. Now see asset turnover. You can get information from asset turnover as well. You can also talk about gross profitability. Okay. So gross profitability, lower selling price might be a reason. Okay. That is the reason. Its revenue is low as compared to this. And you can talk about lower selling price. That's why revenue is low, but better control on expenses. You can talk about better control on expenses in profitability. This might be the reason. You can also talk about the capital employed, right? Now look in capital employed. Candid has government grant, okay? And grant has reduced the amount of capital, okay? And plant is now after accumulated depreciation in government grant, okay? As far as property is concerned, it has no property, okay? So that has an impact. Why there is no property? You can think about. So we can say that as a result, it has low net assets. Low net assets, that's why its capital employed is low, and as a result is, so one of the reason behind good return on capital employed is profitability. Another reason is your capital employed figure. You have to compare this. You have to also write the impact of government grant that has reduced your property, plant and equipment value. Also, you can see here one of the comparison is they have property, they have no property. It means that they are using property on rental basis, rented property. That's why there is a difference in their property value. Okay. Similarly, in the capital employed figure, we have inventory, we have receivables. You can see their inventory is half, the receivable is half. Why half? There might be a size difference, or there might be good working capital management. That's why they have reduced inventory and reduced receivables. Okay. So overall, you can say that the profitability, the return ultimately says that it is a better company as compared to Candid. Okay. So I'm just giving you the reasons. You have to write the full interpretation. First of all, when you write, try to write each and every point. And then with the passage of time, for every question, for every, you can improve yourself. Do you have any question with related to profitability and return on capital employed in your mind, or you want to exchange some further information you think? There is no return on equity. And it's very important that along with return on capital employed, we also consider return on equity. Why? Because we are acquiring a company and we have to show to our shareholders that this particular company is generating how much return for them. Obviously, the company is generating good ROE. So as a valid one point is you have to talk about ROE as well if you have time. Okay. And similarly, I left one point, and that is the asset turnover. You can see here the asset turnover is much greater than covert. And this is the reason. If you can evaluate, we have one formula that is that explains the secondary ratios, that explain the profit margin and asset turnover. So if you have to further, dig down, so you can say that asset turnover. So if my ROCE has been increased, one of the reason is this, one of the reason is this. So in my case, my return asset turnover is also good, and this is contributing to my return on capital employed as well. Okay, so this is the overall profitability. Now let's talk about the another category, that is liquidity and working capital. Now you can see that first obvious thing, it's we have a better liquidity position. The first company is having a better liquidity position in terms of current ratio, obviously, and good working capital ratios in terms of receivables and in terms of inventory. So as their working capital position is good, so that is reflecting in their liquidity position. Okay. And now you can see that why the other company has high inventory and why other company has a high collection period. So you can see, you can write it that the other company has poor credit control, and that is the reason why they have good huge amount of receivables. You can say that as they are generating 40,000 of sales, that's why their inventory is high, because they are generating more sales. So they are generating more sales, so that's the reason why they have more inventory. So this is basically a comparison. A comparison is needed. Why? From the data you have to identify. Now, as far as the solvency is concerned, both are highly geared companies. They have low liquidity. Okay. So low retained earning might be indicating that both the companies are paying dividend. Okay. Why one company's gearing is high, one company is using lease, and as far as the both are identical in terms of gearing ratio. They have high gearing, both, right? One company is having lease, you have to mention here. Another point, that debt is to be paid in 1 year's time. So problem is that they need to arrange finance soon. Okay, if you acquire these one of the company, so obviously both company needs fundings, but the better company looks good company is as compared to uh, candid, as compared to covert. So you can say that they have advantage. Okay, so another point you can see here, the assets. Okay, so the information given in the assets. So you can see here the accumulated depreciation. Covert has own plant that is worth 10,000, and they have accumulated depreciation of 8,000. They have 8,000 plant and accumulated depreciation. So you can see that they have old assets. Their assets are subject to replacement. They have to replace their asset, or you can say that they have to buy new asset, and that requires financing. So in future, the second company is have to raise finance, and as they have already high gearing, so the option left with them is to raise equity. Okay, because they can't afford to have much debt. See, other company has the advantage, it has new asset, it has much fresh assets available. So they have the advantage of taking finance against these assets. And on the basis of that good assets, they can take cheaper debt advantage. The rate might be good one. The rate might be cheaper. So this is the overall position, and conclusion from my side is, if you want to acquire one company, so on the basis of profitability, on the basis of liquidity, Candid is a better candidate. Overall candidate is a better candidate. You have to write why, so you can quote why, and this. But at the end, the company's attitude towards the risk, okay, and the other factors, the non-financial information, that's a very important as well. So you can write in one line that we need to consider other factors as well. So this is the answer of part B. Now in the part C, it has been already asked that you have to ask about other factors, okay. So one of the thing, the other information, some journal information, some specific information. So we can talk about that, the relationship, their customers, their suppliers, okay, the market value of assets, the goodwill, okay, the management expertise, the management capabilities, okay. Similarly, accounting policies, some forward-looking information, the size, the age of the organization. So I've told you a few reasons, right? In part C, what further information may be useful when making an acquisition decision? So compare these two organizations, identify some journal reason, some specific reason, and then just you have to describe that age of the entity might be one factor, the size of the business, the nature of the product, some non-financial information like employee credibility, like employee turnover rate, like relationship with the supplier, how many suppliers they have, the brand loyalty, how many brands they have. We don't have any intangible information, so you can talk about goodwill and other stuff, and you can get 4 out of 4 marks. So this is the complete postmortem of the complete question. In part A, we have calculated ratios. In part B, we have discussed, and in part C, some other information.